Welcome back, focused learners. So today, we've got an incredibly fascinating explainer lined up for you. We're taking a real deep dive into Anheuser-Busch InBev, the absolute titan in the consumer stable space. Over the next few minutes, we're going to pull apart the data and structure a really clear, completely objective look at exactly where this giant stands today. We've got a ton of fascinating metrics to get through, so okay, let's dive into this.
Right off the bat, here's the ultimate investment question we need to answer. If you've been watching the market at all lately, you know this stock has seen a massive rally. But as careful observers, we really have to ask ourselves, for a new investor looking at this stock today, is there still meat on the bone? Are we actually looking at a deeply undervalued global powerhouse, or, well, has the market already fully priced in this recent recovery?
To answer that, we're going to follow a quick three-part agenda. 1. The operational turnaround. 2. The valuation disconnect. And 3. Risks and our final verdict.
Part 1. The operational turnaround. From defense to offense. Let's move to the next slide and see how this builds.
Because the narrative here has definitively shifted. Check this out. In the second quarter of 2026, AB InBev hit a major inflection point. Total beer volumes actually ticked up by 1.1%. Now I know, 1.1% might sound like a rounding error, right? But for a company of this sheer massive size, especially after a long period of stagnation, that is huge. And when you pair that slight volume growth with their frankly incredible pricing power, you get this massive margin expansion. Half-year net income basically skyrocketed from $3.8 billion in the prior year to a staggering $6.3 billion in the first half of 2026. Guys, that is nearly double.
And that bottom line profitability, it was driven by this absolute monster of a top-line number. In just 6 months, the company generated $31.9 billion in sales. I mean, talk about proving your pricing power is holding up. Consumers are clearly still buying, even at these higher price points.
And for us as investors, here is exactly why that $31.9 billion in sales matters so much. It's translating directly and powerfully straight to the bottom line. Earnings per share for the half year came in at a very strong $3.20.
So what's actually under the hood driving all this operational success? Well, we can really trace it back to what we're going to call their Rule of Three framework. These are the three core strategic pillars holding up this incredible growth: premiumization, innovation and beyond beer, and geographic execution. The absolute key takeaway here is this: consumers aren't just drinking more volume, they're actually trading up in value.
Let's look at exactly how those pillars are performing out in the wild. Under premiumization, mega brands like Corona and Stella Artois saw their revenues grow by over 8% in just the first quarter. Under Beyond Beer, their non-beer segment revenues absolutely surged by 37%. And then there's the zero alcohol space. Led by Corona Cero, non-alcoholic beer revenues climbed a whopping 27% in Q2. Basically, they're opening up entirely new consumption occasions that, quite frankly, didn't even exist 5 years ago.
On top of all that product innovation, their geographic execution has just been stellar. The company reported market share gains in 70% of its markets globally. We're talking about record volumes being pumped out in places like Mexico, Colombia, and Ecuador. But, and I really want you to keep this in the back of your mind for later, while this geographic execution is incredibly strong, it isn't completely global. We'll circle back to that shortly.
Okay, part 2, the valuation disconnect. A tale of two models.
I have to warn you, the financial numbers we're about to look at tell two completely conflicting stories. Now, what's really interesting about this slide is the glaring gap between AB InBev and its competitors. If we just look at traditional earnings-based models, this stock looks like an absolute deep value play. I mean, AB InBev is currently trading at a price-to-earnings, or PE, ratio of just 16 times. Compare that to the peer average sitting way up there at 26 times. It's a massive discount.
And it's not like the company is fundamentally underperforming to somehow deserve that discount either. They are highly profitable. We're looking at a trailing profit margin of nearly 15% and an operating margin of over 27%. Normally, for a company with this kind of massive brand moat and market share, numbers like these usually have value investors absolutely salivating.
But here is where we get some major narrative whiplash. That low PE ratio, it's only one lens. When we look at a more comprehensive intrinsic value calculation, like the proprietary GF value model, well, it presents a completely different conclusion. That model suggests the stock is actually 31% overvalued right now. It really highlights the totally bipolar view the market currently has on this company.
So why the huge disconnect? Well,
Part of the GF value model skepticism comes from the fact that the stock has already delivered a stellar return of over 52% in just the last year. Basically, the market has already priced in all that operational recovery we discussed in the first section. The real question is, has the easy money from this turnaround already been made?
Which brings us to part 3, risks and final verdict, the debt and the dragon.
To really understand why the market remains so hesitant despite those amazing operational numbers, we have to look closely at the risks. So the crucial point is this massive figure right here, $72.73 billion. That is the huge debt anchor currently sitting on AB InBev's balance sheet. Now, to be fair, their cash flows are definitely strong enough to service this debt right now, but it heavily limits their financial flexibility. If we hit a sudden global economic downturn, or if interest rates spike unexpectedly, this level of leverage goes from being a mild annoyance to a very significant risk. The market simply won't fully reward this stock until it feels a lot more comfortable with that debt load.
The second major headwind is that uneven growth we kind of foreshadowed earlier. China is the world's second largest beer market, and right now, it's struggling. AB InBev actually saw its China revenues decline by 8.8% in Q2, entirely driven by a weak consumer environment over there. Analysts are staring intently at this metric, trying to figure out, is this just a temporary blip, or are we looking at a systematic red flag for the whole region?
This mix of really strong core operations but high external risks has led to some very real-world market hesitation. Take TD Cowen, for example. They recently raised their price target to $89, but notably maintained a hold rating, stating that the risk-reward is balanced. They clearly acknowledge the great execution, but they think the stock is fairly valued right now. And just for some context, while RBC Capital does have a buy rating at 85 euros, they are very much in the minority among the major firms. The overall consensus is definitely cautious.
So let's synthesize this whole explainer objectively. We're looking at a classic dilemma here, high quality versus high uncertainty. The bull case points to this world-class portfolio of premium brands that's successfully hitting its 4 to 8% EBITDA growth targets. If they keep that up, earnings will inevitably pull the stock price higher. The bear case, on the other hand, argues that a 50% plus rally means the good news is already totally baked into the price, and you're left holding a stock weighed down by nearly $73 billion in debt and a very murky outlook in China.
Which brings us to our actionable summary. Our final verdict on AB InBev right now is a hold, but with a strict watch list rating. For those of you looking for a low-risk entry, patience is absolutely your best friend here. We want to wait for those Q3 earnings. We really need to see stabilization in China and continued sustained volume growth in the Americas. Plus, if a broader market dip happens to come along, that could provide the exact margin of safety needed to make this a really attractive long-term entry point.
Which leaves us with this final thought to ponder. If the perfect turnaround is already priced into the stock today, what will it actually take for AB InBev to unlock its next massive wave of growth? Is it going to be further innovation beyond beer, or maybe a surprise recovery in Asia? We'll have to keep an eye on those Q3 numbers. Thank you so much, as always, for your time, focused learners, and for joining me on this deep dive. Keep asking the right questions, and happy learning.